a lesser known tax strategy that could allow you to pay a tax rate of 0. Yeah, like 0.00. Pretty great. So check it out. Yeah, what we're talking about is often when you have a brokerage account, if you have losses, we talk about, okay, well, maybe we want to sell those positions, wait 30 days to avoid a wash sale, and then you could buy back those same positions, but you realized a loss to offset other gains for tax purposes. Well, that's a great strategy if you have losses. But here we are, 2023, the market's been up. It's been a good year. And a lot of people are sitting on gains, maybe sizable gains. Well, as long as you held those investment positions for more than a year, and as long as they're in kind of a non-retirement account. So this doesn't apply to IRAs, Roth IRAs, SEP, Simple, all the kind of 401ks and things that are through maybe an employer and kind of a retirement account. If these are through a brokerage account, a joint account things, if you have gains and if you're in a low enough income tax bracket, the long-term capital gains bracket can be at 0%. So what does that look like? So if you're single, you have to be below a taxable income of $45,000. But the cool thing is the standard deduction kind of adds to that. In other words, $45,000 is taxable income after that standard deduction. So for single person, standard deduction is $14,000. So 45 plus 14, that actually gets you up to $59,000. So as long as you're single making total income of $59,000 or less, then you actually can be in a 0% long-term capital gains bracket. And a similar thing if you're married filing jointly. That's right, it can go up to about $118,000 after the standard deduction for married filing jointly. Now keep in mind, if you have, let's say, $20,000 of long-term capital gains that you want to realize, that long-term capital gain is going to count against those numbers, so the 59 or the 118. So make sure you're not realizing so much that you kind of kick yourself into the next higher tax bracket where those capital gains all of a sudden can be realized. But the nice thing here is you're not going to blow up the whole thing. Let's say if you're at married filing jointly at 118 and you're at 100, so you realize $20,000 of long-term capital gains. Well, the first $18,000 are going to be taxed at a 0% tax bracket. And then the extra 2 that you kind of pushed above that limit are going to be taxed at that long-term capital gains rate of 15, kind of at that taxable, that next tier. So it's either 0, 15, or in the highest tax bracket for long-term capital gains, you're at 20. And then on top of that, there's a nuance of if you're above an income of about $250,000, there's also added to those net investment income tax, which is an extra 3.8% on top of the either 15 or 20% long-term capital gains brackets. So the top bracket, so to speak, you could be paying, including the net investment income, is that 23.8. So this is a strategy that, if implemented correctly, you can actually wind up saving almost 25% in long-term capital gains taxes by selectively selling those assets at a gain. And the really nice thing here is you don't have to worry about wash sale rules. Wash sale rules only apply when you're selling at a loss. Meaning if you're selling at a gain and realizing taxes, if you still like the underlying investment, you could sell it and buy it back almost instantaneously. So a sell and then a buy in the same day is fine. And because you did sell at a gain, that will actually trigger that sale as a capital gain realized. And potentially you could not pay any taxes if you're in those lower tax tiers. So cool way to really save on income taxes and do some income tax planning as you prepare and go through retirement. Thanks for watching.